Most inexperienced traders and investors don't realize this, but the moment a stock looks the strongest is oftentimes the worst time to actually buy it. So it's moving fast, it feels like it's about to keep going, and it seems like if you don't get in now, you're going to miss out. But more often than not, that's exactly where price pulls back. So in this video, I'm going to show you why traders keep chasing price, what's actually happening on a price chart in those moments, and how to start entering trades in a much calmer and more structured way. So what we're going to cover is why people keep chasing, why stocks often pull back after big moves, how to identify resistance and support, which is key, and why often the back test after a breakout is much better for calmer, less stressful entries. So let's jump right into it. We're going to cover points 1 and 2, and then we're actually going to go look at some actual chart examples. But let's quickly cover these, and then we'll go look at TradingView. So the first reason traders buy the top is because of emotion. So it's important that we recognize when we're feeling sort of urgency to chase to get into a stock rather than clarity from some technical indicators or some objective sort of data. So we want to also notice a stock when it starts to feel excited only because it's already ran up quite a lot. We oftentimes want to buy stocks and enter trades at support levels before a breakout has happened. So if things already run and we sort of chase, we need to sort of understand and start being aware that we're making those types of trades. We want to start also assuming that you need to get in immediately. So stocks always pull back. They always run up to what's called a resistance zone. And if we keep having that feeling like we're going to miss out, there's never going to be an opportunity to buy in again, then oftentimes you're going to just buy at the worst time. So we want to ask ourselves, am I buying a setup or am I just reacting to momentum? So this happens a lot to beginners. It's happened to me before. Stock runs up, people start talking about it on social media. It feels like the opportunity is disappearing. So we jump in, and not because the entry is good, but because we don't want to miss the move. So this has happened a lot. I'm going to show 3 examples of this on the charts. But what goes hand in hand with this is that one, we're trading with emotion, we're chasing, and we don't know any clarity in terms of the charts. We don't know how to use some technical tools to identify what's called a resistance zone. So we need to really learn how to identify resistance and not enter around those areas. We want to look for things like a previous high in the market structure or some simple tools that will tell us that, hey, there might be some selling pressure in this zone. So if price is near resistance, we want to be more cautious rather than enter the stock. We want to only enter at support. So I think a lot of people, especially those with inexperience, and again, I've been there, is we make a trade and it falls off. We think it's bad luck. But many times what we did is we just bought the wrong location on the chart. So let's go look at some charts and we'll show this as an example. So here, this first stock is called Roblox. We're on the weekly chart here. So all these candlesticks represent 1 week. And we can see that since April 25, this stock has run up a lot into this zone, and then it's come back a lot, and it's in a better zone than it was up here. So here at the top, we can kind of call this resistance. And I just found a few quotes from posts on X, and one was right here in the fall of 2025 saying, from an account that had a good amount of followers, there's a stock that's up nearly 200% this year, and I still think it's underpriced. I might even call this criminally underpriced. And that was basically right at the top. So you really need to be careful. Social media, people posting, they're just sharing their ideas. They're trying to be helpful. But if they can't read a price chart, then you're going to enter at this area. And, people who have read that and bought, a lot of people have, if they stuck with their position, they're down over 50%. Another example is a stock of Duolingo. Right around the summer of 2025, we can see here in this zone, a post from a popular account wrote, most investors still think Duolingo just as a playful language app. Duolingo today is what Amazon was to e-commerce 2 decades ago, right around the high 300s, and it's fallen down to 90%. Spotify is another chart around 725. Stock prices track free cash flow per share over the long term. Spotify's free cash flow share per share continues to explode, and the stock fell down to $400 level. So unfortunately, when people read these things on social media, on X, other platforms, without being able to look at a price chart and do some technical analysis, they're going to buy. A lot of people would have followed these accounts. They would have bought here at the top, and their positions would be down 20, 30, 50%. So if we just apply some basic technical analysis to these charts, we can see why buying around this time, you probably should have been a bit cautious. If you did make entries, you would want to track them carefully to see if there's any trend changes and then get out before the collapse. So this particular example, if we just hide this quote and we just look left, we can see that Roblox had a previous high from November 21 around the 140. So anytime a stock runs up to a previous high, you really want to be cautious. You want to confirm that that area is flipped to support and that the stock can break through, because oftentimes there is a lot of selling pressure around previous high. And some market structure lessons, we see this big wick here and we don't make a higher high. So this candle here, all of these highs are actually lower highs. There's no trend continuation. There's no breaks of structure for continuation. So there's some warning signs just based on market structure that we should be a little bit cautious here with our entries. And if we just put on some technical tools like a fib retracement, again, we can see that we've got a high from the previous one we just showed. So the stock is at a resistance zone, and then we lose another fib and we flip it to resistance and we track down. Now, if we want to add in a few other technical tools, we can put on what's called the Ichimoku cloud as well. And right around this area, we have a bearish cross on this Ichimoku cloud. So we ran up to an all-time high. We didn't break through. We lost another fib. And then we get a bearish cross on a technical indicator. And then we put on some simple moving averages that we lost later on. There's a few signs here saying that we have a bit of a trend change, and it's actually not a great time to enter this stock. One, the previous all-time high. Two, we get a bearish cross on the Ichimoku cloud. And then with some of these bearish candles, we actually can make a bit of a trend change in character based on market structure. Same with Duolingo. In this area, if we just hide this and we can just put on a simple fib retracement as well. In and around this area, we've got the 1.618 fib retracement on log scale, which is a difficult major fib to break above for many stocks. Here we can see we got rejected in February. We tried to close above it and we did, but then we came down, we flipped it to resistance. So some warning signs that we've got some resistance in this area, and then we make some lower highs here. More warning signs that we have some weakening price action. And right here with this bearish candle, we make a change of character to the downside. So if we put on some other tools as well, we also have a bearish cross here in this area. So there are a few signs: resistance with fibs, resistance with these technical tools, a bearish cross, market structure changing. 3 warning signs that Duolingo is changing its trend, and you probably should be cautious and be careful with your entries in and around this area. And then Spotify, the same thing. If we just hide this and we put on a technical tool to help us see resistance, this is actually a Gann square, and we can see Spotify has run up to this Gann square and it's just not been able to close consistent candles above this arc, and it's flipped it to resistance. And we have a high here, we have a lower high, our market structure changes. So a sign that the trend is changing, we're consolidating and needing to pull back. Not a indication that the stock, the free cash flow per stock means that this is going to continue to the moon. We want to really consider the technicals. And here we get a couple warning signs that we don't want to continue. We need to pull back, and the trend is changing. So for 1 and 2, don't trade with emotion. you actually look objectively at the charts and then learn a few key technical indicators that can help us identify what's called a resistance zone on a chart. So I know I went over that quickly. Below this video in the YouTube description, the first link, you can come and join this Stock Trading for Beginners group. It's free. It's our free community. We do chart reviews. We have a live Q&A session every week. And in the classroom section, there's actually a trading course. And you can go through the technical analysis modules, the Ichimoku cloud. We mentioned that one here. Fibonacci retracements. There's a lesson on this. It's completely free. And you can come and learn more about some of those technical tools that we just went over there. So emotions, technical clarity, and then we want to start thinking in terms of support and resistance. So rather than solely based on the fundamentals or based on someone's post on X, we want to really be able to identify support and resistance and understand that a resistance zone on a price chart is an area where the probability that sellers step in is high. We don't want to buy when there's a high probability that more people are going to come in and sell. There's more selling pressure. We want to buy at support where there is more buyers coming in. The probability that more buyers step in, that the price stabilizes and continues higher is on your side. That's where you want to buy. So we want to start asking questions like, is price actually pulling into support, or are we running into resistance? Again, we don't want to buy resistance. We only want to buy support. So this will help with, chasing what looks strong. Personally, it's helped for me rather than looking at the charts and buying the green days and chasing a stock that runs up to euphoria. I want to analyze the chart and think, am I running into resistance? That could be dangerous. Instead, are we getting a pullback into support? That could be a much better trade. And this makes trading much more calm and much less stressful as well. So the other points that we want to touch on after identifying your emotions, identifying some key chart tools to identify support and resistance, is that we also want to sometimes wait for what's called the backtest after a breakout. So there are some charts that break out, and if you miss it, you don't want to chase, you want to wait for things to pull back into a support zone, and that's when you can actually buy. So a lot of strong moves, they actually happen after a backtest of a breakout. So at the time of recording this, I've got two quick examples here. The stock NBS, we can see that over the last few weeks, we had a candle here in early March that went up 26%. And you often don't want to chase and buy that into what was resistance in this area. You want to wait for some sort of backtest. And this prior week, we backtested the top of the cloud. That was your entry if you weren't buying this fib at support over the previous couple months. A big breakout into a resistance area, backtesting support. There is a good entry. One other one, we saw Netflix fall down quite a bit, and then it had a 22% week, and it ran up to the bottom of this cloud and another resistance zone. So we don't want to chase and buy resistance. We want to wait for some type of backtest of this 100-week moving average and a fib level. Oftentimes, backtesting a support zone instead of buying a breakout over the long term is going to be much, much better for you. So just a quick point on the actual entries there. And then lastly, we want to also use one simple rule before you enter a trade that's going to help you avoid buying the tops of stocks. Simply ask ourselves this question: is price near support or near resistance? Is the structure still bullish? So we always want to make sure that we're buying a chart that the overall market structure is bullish. We're making higher highs, we're making higher lows, at least on the monthly time frame. Is there confluence in this area? So oftentimes we want to buy where we have multiple tools telling us that this is a support zone. Some buyers are going to step in. And if we don't have any of those yeses, if we don't have all three, then we wait. We move on to another stock. Don't get stressed. Don't buy based on emotions. Wait for the technicals to line up, and you're going to be much better off in the long run. So instead of asking a question, when we see a stock, when we see something moving, how fast can I get into this? Don't ask that. Instead, think more on the lines of, is this actually a good location on the chart? And that's a completely different mindset, but one that I think will serve us well as we continue to trade into the future. So again, only buy support, never buy resistance. So just a quick recap of this video. If you find yourself buying stocks at the worst time, many people have done it. All beginners have done it. I've done it in the past. It's usually, not bad luck. It's basically comes down to either trading with emotions, which you don't want to do, having the fear of missing out on a stock, which you don't want to do. There's always going to be opportunities for stocks to pull back into better zones on the chart, not recognizing resistance. So you need to be able to buy and recognize resistance, not buy resistance, only buy support. We want to wait for support. So if you're not waiting and being patient for support, then I think you're going to be stressful and make a lot of bad trades. And then it comes down to chasing the breakouts again, instead of waiting for some back tests if you weren't in the stock already. So the simple fix, again, identify resistance with some technical tools, identify support with those tools. That's where the buyers step in. Stop trading with emotions. Be aware that you're doing this as well. Having rules set up with your trading plan is going to really help eliminate emotions. It's kind of hard to eliminate them completely, at least at the beginning. Mindset, emotions with trading is very difficult. But when you have some rules, when you have a community, when you have some feedback that you can get with charts and with some of the trades that you're making, then that can really help, cure this trading with emotion problem that so many people have. And we want to wait for a better chart location. Again, just buy support, not resistance. Over time, I think that will really help with our level of calmness and a system that we can follow that's repeatable and it's low stress. So I hope that you found this useful. Again, below this video, if you'd like to learn more about the strategy that I use, some lessons on some of the technical tools that we went over today, like fib retracements, that Ichimoku cloud, and how to just identify some market structure basics. So you're not buying the top and you can identify when there's a trend change based on market structure. You can come and join our free trading community. You can find the link below this video in the description. And I hope that you found this useful, and I will talk with you in the next one.